Our next guest is in charge of corporate credit at Goldman Sachs, advising America's biggest companies on their multi-billion-dollar financings. Jonny Fine, Goldman Sachs Global Head of Investment Grade Credit, joins us. Welcome back. It's good to have you.
Thank you. Great to be on with you again.
So, we all know there's going to be a reckoning in the bond market at some point. The question is he right to raise the alarm now?
So I agree with the general thrust of what Jamie's saying. I agreed with what our president and COO, John Waldron, said last week in that the deficit was a bigger issue for markets than tariffs were, and that there was going to be at some point a dislocation in the bond market, probably in the long end. I agreed with David Solomon, our CEO, at the beginning of the year when he said that we need to be super focused on deficit, debt, and overall financing of Treasury. But this isn't a new story. This has been something that has ebbed and flowed for a really, really long time. In fact, coming out of the financial crisis, then President Barack Obama in 2010, he set up a commission to look at fiscal reform. And at that very first meeting, then Fed President Ben Bernanke talked about how we would need to have meaningful fiscal policy reform at the government level if we were to have any hope of lessening our deficits.
It's the Simpson-Bowles, right? Time?
Correct.
Yeah.
So for 15 years, we've been talking about it. It's been ebbing and flowing.
But are we reaching that moment?
We're certainly flowing more readily in terms of it being very topical for the markets and it creating certainly term premium in bond markets overall. And I don't know if ultimately we'll reach a tipping point in the next 5 years. I don't think it's going to be in the next 12 months. But it will happen at some point or another. We should be focused on it because even when you look at term premiums today reflecting this, there's 75 basis points of incremental yield embedded in 10-year yields. That gets passed on in the form of mortgage rates being 75 basis points higher than they otherwise would be. It gets passed on in corporate issuance rates being 75 basis points higher than they otherwise would be. It's a real tax on the economy.
So we're starting to feel it, you're saying. We're just not at a crisis moment.
We're starting to feel it. I don't think we're in a crisis moment as it stands right now. Really, the fiscal balances as they stand today is a continuation of what we've had over the last several years. It's not got any better. It's not really got any worse either. It's going along the same path.
It's only a problem, though, Jonny, right? If people don't want to buy our bonds. It's a demand problem. Is there any sign of that? Any sign of foreigners, for instance, or any buyer strike?
No, I don't think so. If you look at the foreign holdings of US Treasuries as they stand today, they get reported weekly, kind of unchanged over the course of the last kind of couple of months or so. And so even with the theme of the waning of American exceptionalism, we've seen how that's played out. It's a weaker dollar, it's higher Treasury yields, it's higher gold and cryptocurrency prices overall. I don't think there's liquidation of dollar assets. I think marginal dollars, as they get recycled into financial assets, I think they're looking for other homes. And that's creating, I think, a bigger uplift to international equities. And it's actually led to a pretty interesting broadening of international capital markets activity outside the US as well.
And you think that trend continues?
I do. If you kind of think about in the world that I traffic in and day out in global financing markets, the two biggest markets are the dollar markets and the euro markets. Traditionally, the split between financing volumes is around 70% in dollars and 30% in euros. Since April 1, where we really, I think, mark the end of the American exceptionalism trend, that's been more like 60-40. We just finished the busiest ever non-financial corporate issuance month in euros. We're seeing a lot of US issuers finance in the euro markets. There's real demand dynamics, I think, driving European fixed income markets as capital allocations flow into non-dollar opportunities. And also with a 200 basis point or so yield differential between 10-year dollar rates and 10-year euro rates, companies in the US are very much incentivized to try and finance their international operations at a lower yield.